Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Commercial mortgages. Commercial mortgages are an essential aspect of financing for businesses looking to purchase, develop, or refinance commercial property. They differ from residential mortgages in that their purpose is solely for business-related properties, such as office buildings, retail spaces, and industrial facilities. Understanding the ins and outs of commercial mortgages can help business owners make informed decisions and choose the best mortgage provider to suit their needs. Understanding commercial mortgages. In the world of financial products, commercial mortgages hold a significant place. They are loans secured on property that is not your residence, and can be used for various business purposes. Let's delve deeper into understanding commercial mortgages and how they differ from residential and buy-to-let mortgages. Firstly, it is important to know that commercial mortgages are typically utilized by businesses to finance the purchase or refinance of commercial properties. These properties can range from retail premises, office spaces, agricultural land, and many other types of non-residential real estate. Unlike a residential mortgage, which is taken out by an individual for their own home, a commercial mortgage is specifically designed for businesses and their unique needs. One key difference between commercial mortgages and residential mortgages is in the way they are assessed by lenders. While residential mortgages primarily take into account your personal credit history and income, commercial mortgages assess the financial stability and profitability of your business. This means that the business itself needs to have a solid trading history, or a clear plan for future growth, to increase the likelihood of being approved for a commercial mortgage. Buy-to-let mortgages are a type of commercial mortgage which is specifically designed for the property investment market. They are generally used to finance the purchase or refinance of residential properties that will be rented out to tenants, rather than being used by the mortgage holder themselves. This type of mortgage is subject to different criteria and regulations than both residential mortgages and standard commercial mortgages, due to the focus on rental income as a key factor in determining affordability and loan approval. When considering a commercial mortgage, you should also be aware that it may come with a higher interest rate than a residential mortgage. This is because lenders often view commercial properties as a higher risk, given the reliance on the success of the underlying business. The terms of a commercial mortgage can also be more flexible and bespoke to your business needs compared to a residential mortgage, with lenders working with you to structure the repayment schedule and loan duration to suit your company's financial position and strategy. In conclusion, commercial mortgages are a critical financial product for any business aiming to invest in property. Whether it is to expand your operations, generate rental income, or refinance commercial real estate, understanding the differences between commercial mortgages and other financing options, such as residential mortgages and buy-to-let mortgages, is crucial in making the best decision for your business. Benefits and disadvantages of commercial mortgages. In this section, we will discuss the benefits and disadvantages of commercial mortgages, focusing on aspects such as flexibility and stability. One of the main benefits of a commercial mortgage is the potential for capital growth. As property prices generally increase over time, owning a commercial property can lead to significant gains in the long run. In addition, you may be able to borrow more with a commercial mortgage compared to other types of financing, which can help you secure a larger property for your business needs. Another advantage is the flexibility that commercial mortgages offer. You have the freedom to sublet or lease out parts of the property, which can generate additional income. Moreover, you can make alterations to the building without having to seek permission from a landlord, allowing you to adapt the space as your business evolves. However, commercial mortgages also come with certain disadvantages. One of the main drawbacks is the commitment to a long-term financial obligation. Commercial mortgages typically have terms ranging from 15 to 25 years, which might not suit businesses that prefer shorter lease agreements for greater mobility. The stability of a commercial mortgage may also be a double-edged sword. While it ensures that your business premises are secure, it can also mean that you are tied to a specific location for an extended period. This can be a disadvantage if your business needs to relocate or downsize. Furthermore, commercial mortgages often require a higher deposit than residential mortgages. This means you will need a significant amount of capital upfront, which could be a barrier for some businesses. Interest rates for commercial mortgages can also be less predictable, and you may face additional fees such as valuation and legal costs. In summary, commercial mortgages offer various benefits such as capital growth, flexibility, and stability. However, they also come with disadvantages like long-term commitment, upfront costs, and potential restrictions on business growth. It's crucial to weigh up these factors when considering a commercial mortgage for your business needs. Eligibility and application process. When it comes to commercial mortgages, eligibility and the application process are important aspects to consider. To help you navigate through this financial territory, we'll cover the main factors involved in determining your eligibility and the application process for a commercial mortgage. First and foremost, assessing your eligibility for a commercial mortgage involves meeting specific eligibility criteria. Generally, you'll need to have a solid trading history, often spanning at least 2 years. This demonstrates your ability to generate sufficient income to support the mortgage repayments. However, certain lenders may consider your application even if you have a shorter trading history, under specific circumstances. Some lender may require a well-prepared business plan. Your business plan should outline your company's growth projections, financial forecasts, and details of how the mortgage will be used. A strong business plan instills confidence in potential lenders and can improve your chances of securing a commercial mortgage. Now let's move on to the application process. The process of applying for a commercial mortgage begins with gathering the required documents. Typically, lenders will ask for a range of financial records. These can include company accounts for the last 2 to 3 years, bank statements for up to 6 months, details of any existing loans or credit agreements, proof of identification for company directors. Once you have these documents organized, it's time to approach potential lenders. While some lenders may have predetermined criteria, keep in mind that the whole market is available for you to explore and find the most suitable product for your business needs. Applying for a commercial mortgage can be a complex process, but by understanding the eligibility criteria, preparing a strong business plan, and navigating through the application requirements, you're more likely to secure the financing you need for your business. Remember to approach a variety of lenders and be prepared to negotiate terms to find the best fit for your specific situation. Interest rates, fees, and repayments. When considering a commercial mortgage, it's essential for you to understand the interest rates, fees, and repayment structure. This can help you make an informed decision about the best financial solution for your business. Commercial mortgage interest rates can vary significantly depending on several factors, such as your business profile, credit history, and the property type. Typically, owner-occupied commercial mortgage rates varies. Generally, the higher the risk associated with your business and property, the higher the interest rate charged. You should be aware that commercial mortgages can have either a fixed or variable rate. Fixed interest rates provide certainty on your repayments over a set period, making it easier to budget and forecast cash flow. On the other hand, variable rates may change over time in line with market fluctuations. This can result in lower repayments when interest rates are favorable, but may cause challenges if rates rise significantly. Along with interest rates, you will also encounter fees associated with your commercial mortgage. Some of the common fees include arrangement fees, charged by the lender for setting up the mortgage. Valuation fees, required to assess the value of the property being mortgaged. Legal fees, payments to solicitors for handling the legal aspects of the mortgage transaction. When comparing commercial mortgages, don't forget to factor in these fees to get a true understanding of the overall cost of your borrowing. Repayments on your commercial mortgage will consist of both principal and interest components. The principal is the amount borrowed, and the interest is the cost of borrowing that money. Repayment schedules can differ, with some mortgages having interest-only periods followed by full capital and interest repayments. Make sure you understand the terms and plan accordingly to manage your cash flow effectively. In summary, understanding the interest rates, fees, and repayments associated with commercial mortgages is crucial for making the right decision for your business. Consider factors such as fixed or variable rates, associated fees, and the structure of the repayments to find the best mortgage solution that fits your financial needs. Security and equity in commercial mortgages. When you apply for a commercial mortgage, the lender will typically require some form of security. In most cases, this security will be the property you intend to purchase or an existing property that you already own. This is because the lender needs to ensure that they can recover their funds in the event of default on the loan. In order to secure a commercial mortgage, you need to have a certain amount of equity in the property. Equity refers to the difference between the market value of the property and the amount you owe on any existing loans or mortgages. The more equity you have in the property, the more likely you are to be approved for a commercial mortgage. Lenders often express the amount of equity required in terms of the loan-to-value (LTV) ratio. The LTV ratio indicates the percentage of the property's market value that you can borrow. For example, a property worth £100,000 with an LTV of 80% would mean that the lender covers £80,000, leaving you to provide a deposit of £20,000. Your equity can be built up over time through property price growth, or by making additional payments towards the principal of your existing loan. You can also release equity from an existing property by using the funds to repay a portion of your outstanding mortgage. When considering a commercial mortgage application, lenders look at various factors, such as your credit history, business performance, and the value of the property you intend to purchase. It's essential to demonstrate that you can afford the monthly repayments and that your business has a stable income. To ensure a smooth application process, prepare all necessary documentation and financial records. Consult with a commercial mortgage expert to understand the requirements and maximize your chances of approval. Remember to carefully assess your financial situation and the potential return on investment before committing to a commercial mortgage. By securing the right mortgage and maintaining strong equity in your property, you can ensure the long-term success of your business venture. Financial implications and projections. When considering a commercial mortgage, it is crucial to understand the financial implications and create accurate projections for your business. This section will guide you through the essential aspects you need to consider. Firstly, analyze your income and expenditure, incorporating all possible revenue sources, such as rental income from the property. Evaluate your current financial situation and ensure that you have a realistic plan to meet mortgage repayments, taking into account factors like interest rates and the length of the mortgage term. Be prepared for fluctuations in income, particularly if your rental income might vary. Another important element to consider is the capital repayment holiday, which is a period during which you don't make any principal repayments on your commercial mortgage. This can help you manage your cash flow more effectively early in the mortgage term, but be aware that during the capital repayment holiday, you will still need to make interest payments. When preparing financial projections, you must take into account your business's growth strategy and potential changes in operating costs. It is essential to include realistic and achievable projections of revenue and expenses to get a comprehensive understanding of the affordability of the commercial mortgage. The preparation framework by IQ can be helpful for this purpose. To summarize, understanding the financial implications and creating accurate projections for a commercial mortgage is essential to ensure a successful investment. Consider your available finance, rental income, and potential capital repayment holiday, and maintain realistic expectations to achieve your business goals. Role of various stakeholders. In the realm of commercial mortgages, various stakeholders play crucial roles in the process. As you navigate this journey, it's essential to have a clear understanding of how each stakeholder contributes to the successful acquisition or refinancing of commercial properties. Banks are the primary lenders in commercial mortgages. They assess your creditworthiness, property value, and business plans to determine if you qualify for a loan. Keep a well-prepared application and maintain good relationships with the banks, which can increase your chances of securing attractive terms. Brokers can be instrumental in helping you find the best commercial mortgage deal. They have extensive knowledge of the market and can guide you towards suitable lending options based on your business needs and financial criteria. By leveraging their industry connections and experience, you may discover opportunities you otherwise wouldn't have found. A landlord is typically involved in commercial mortgages when you're purchasing a property with existing tenants. Their role is to provide information about the property, rental income, and lease agreements. Make sure to communicate effectively with the landlord to ensure a smooth transition of ownership. Solicitors play an essential role in the legal aspect of commercial mortgages. They handle property due diligence, register property titles, and draw up loan documents. Engaging a reputable solicitor can help you navigate legal complexities and protect your interests in the transaction. Accountants are vital for ensuring your business's financial well-being. They can help you analyze the financial aspects of a commercial mortgage, including tax implications and cash flow projections. By having a thorough understanding of your financial health, you can make informed decisions when selecting a commercial mortgage. Finally, a relationship manager often serves as your main point of contact during the commercial mortgage application process. This professional is responsible for understanding your business needs, facilitating communication between you and the lender, and supporting you throughout the loan process. Establishing a strong rapport with your relationship manager can lead to valuable insights and smoother transactions. By understanding the roles of various stakeholders in the commercial mortgage process, you can ensure your business has a strong foundation for success in the property market. Refinancing and remortgaging commercial scenario. When you're considering refinancing or remortgaging your commercial property, it's crucial to understand the process and benefits. With the right strategy, remortgaging can help you save money, raise finance for business growth or improvement of non-residential property. It's essential to work with a commercial finance broker who can assist you in finding the best deals and navigating the complex world of commercial mortgages. These professionals have an in-depth understanding of the market and have access to a wide range of lenders that cater to specific business needs. When you begin the remortgaging process, lenders will assess your application based on various factors. In general, a mortgage provider will look at earnings before interest, tax, depreciation, and amortization, EBITDA, to determine affordability too. Prepare your financial statements and ensure they accurately reflect your business's financial health. It's also essential to consider the loan-to-value ratio, LTV, which indicates the percentage of the property value secured by the mortgage. A lower LTV ratio means lower risk for lenders, potentially resulting in more favorable terms for you. Moreover, keep in mind the associated costs when refinancing your commercial mortgage. These may include valuation fees, legal costs, and early repayment charges on your existing mortgage. A good commercial finance broker will help you identify and compare these costs, ensuring that remortgaging is the right option for your business. To ensure a smooth refinancing process, maintain open communication with your lender and broker. Provide accurate information, keep your expectations in check, and be prepared to negotiate terms that meet your business objectives. In conclusion, refinancing and remortgaging in a commercial scenario can be a viable option for businesses seeking more favorable mortgage terms, or additional funds for growth and improvement. By working with a knowledgeable commercial finance broker and carefully evaluating your financial situation, you can make the most of this opportunity to benefit your business. Choosing the right commercial mortgage provider. When it comes to selecting the right commercial mortgage provider, it's essential to evaluate the options available to you. There are various types of providers, including high street banks, challenger banks, and specialized commercial mortgage brokers. Ultimately, your choice should be based on your specific business needs, financial situation, and the property you intend to purchase. High street banks are often the first port of call for many business owners seeking a commercial mortgage. They usually offer competitive interest rates and terms, as well as the familiarity of working with a well-established institution. However, in some cases, high street banks may have stricter lending criteria and may not cater to all types of borrowers, such as those with adverse credit histories. Challenger banks, on the other hand, can be a good alternative to high street banks. These banks are generally smaller, newer institutions that aim to provide more diverse and innovative financial products and services. They may be more flexible and willing to work with borrowers who do not meet the strict criteria set by high street banks. However, it's crucial to research each challenger bank, as they may not have the same level of financial stability or reputation as their more established counterparts. When looking for a commercial mortgage, keep in mind the importance of comparing various loan terms, interest rates, and other features. A mortgage broker specializing in commercial property can be a valuable ally, as they can help you navigate the market and find the best deal for your particular situation. Working with a broker can save you time and effort, as well as provide you with access to a wider range of lenders and bespoke options. In summary, when choosing the right commercial mortgage provider, it's crucial to consider your specific needs and financial circumstances. Always compare offers from various providers, including high street banks, challenger banks, and commercial mortgage brokers, to find the most suitable deal for you. Frequently asked questions. What are the different types of commercial mortgages? There are several types of commercial mortgages available to suit various business needs. Some common ones include owner-occupied mortgages for businesses looking to purchase their own premises, investment mortgages for investors buying commercial property, and specialized mortgages for specific sectors like retail or hospitality. It's essential to assess your business requirements and financial situation to determine the best type of commercial mortgage for you. How are commercial mortgage rates compared? Commercial mortgage rates are usually compared with reference to the Bank of England base rate or some other benchmark rate. Lenders may advertise their rates as a fixed or variable rate above, or sometimes below, this benchmark rate. To compare commercial mortgage rates, it's crucial to consider not only the interest rate but also any fees and charges associated with the mortgage, as these can significantly impact the overall cost. What is the typical deposit required for a commercial mortgage? The deposit required for a commercial mortgage depends on the lender, the property type, and the perceived risk associated with the borrower. Generally, commercial mortgages require a larger deposit compared to residential mortgages, with deposit requirements often ranging from 20% to 40% of the property value. How do I apply for a commercial mortgage as a new business? If you are buying for investment purposes, the application can be a straightforward process. However, as a trading limited company, applying for a commercial mortgage as a new business can be challenging, but it's not impossible. Start by preparing a strong business plan, including financial projections that demonstrate your ability to repay the mortgage. You also need to have a deposit saved up, usually at least 25% of the property value. Approach lenders who specialize in commercial mortgages for new businesses, and be prepared to provide extensive documentation and financial information to support your application. What is the maximum LTV for a commercial mortgage? The maximum loan-to-value, LTV, for a commercial mortgage varies depending on the type of property, the borrower's circumstances, and the lender's policies. However, it's common for commercial mortgages to have a maximum LTV of around 70% to 75%. Borrowers with a strong credit history, good cash flow, and substantial collateral may be able to secure a higher LTV. How are commercial mortgage repayments calculated? Commercial mortgage repayments are calculated based on the loan amount, the interest rate, and the loan term. Repayments can be structured as interest only, where you pay only the interest on the loan each month, or capital and interest, where you pay both the interest and a portion of the loan principal each month. Using a commercial mortgage calculator can help you estimate your monthly repayments, and better understand the financial commitments associated with a commercial mortgage. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.